Bitcoin has just entered what analysts are calling the fastest bear market in its entire history. A sudden drop, billions flowing out, fear rising across the market charts, breaking down, sentiment collapsing, and traders panicking. But beneath all this noise, something surprising is forming, a deeper pattern that points toward a potential bullish turnaround by year-end. Most traders are looking at the red candles, but smart money is watching the macro signals building in the background. Let's break down the full picture with clarity and depth. Bitcoin recently sank to around 80,600, marking a massive monthly decline. The total crypto market cap fell from 4.2 trillion to roughly 2.8 trillion. In just a few weeks, this kind of drop is rare, fast, and aggressive. Major analysts described it as one of the fastest moving bear markets ever recorded, and when you look closely, the data supports a crypto investment. Products saw over 2 billion in weekly outflows across 3 weeks. Investors pulled more than 3.2 billion out of the market. Bitcoin funds alone faced around 1.4 billion in redemptions. Ethereum was hit with another 689 million in losses. Even BlackRock, the biggest name in the ETF space, saw record outflows. This isn't just small traders running away. This is heavy institutional repositioning, likely driven by interest rates, inflation, uncertainty, and tightening liquidity. The macro pressure has been building for months, and now it is showing its full impact. Bitcoin also slipped below the 100-week exponential moving average, a long-term trend indicator that often marks a shift in market structure. Dropping below this level signals weakness, but it also shows that the market is nearing a reset zone. But there is a deeper indicator most traders never watch: National Financial Conditions Index, the NFCI. Over 10 years of data and analysis of more than 100 financial indicators show a repeating pattern. When the NFCI moves downward, financial conditions loosen, and about 4 to 6 weeks later, Bitcoin historically reacts with upward momentum. Right now, the NFCI sits near minus 0.52 and is continuing to decline. Historically, each 0.10 drop in the index aligns with roughly 15 to 20% upside for Bitcoin. The index pushes toward minus 0.60. It could mean an even stronger rebound. This makes the NFCI one of the most important silent indicators to watch right now. The Federal Reserve is preparing to shift mortgage-backed securities into Treasury bills. This is not officially called quantitative easing, but the effect mirrors added liquidity. More liquidity usually means better risk appetite. Better risk appetite often means a stronger setup for assets like Bitcoin. This rotation lowers borrowing stress, improves financial flow, and quietly loosens conditions. Many analysts view this as the spark that could align perfectly with the NFCI trend. When liquidity improves, markets don't stay suppressed for long. This fast downtrend may look disastrous, but it is also functioning as a massive flush out, leverage getting wiped, weak hands getting removed, and overextended positions getting reset. This is how long-term bullish setups usually form. Not when everything is euphoric, but when everything looks broken. If the NFCI continues dropping through mid-December, the historical 4 to 6 week lag points towards a recovery window forming as the year ends. In other words, the bear move might be clearing the path for the next bullish wave. This is why analysts say that under the panic, a potentially positive year-end outcome is forming quietly. On the surface, Bitcoin looks like it is collapsing, but deeper signals show that the market might be transitioning, not dying. Tightening conditions caused the crash, but improving liquidity and macro cycles could spark the rebound. As always, this is not financial advice, But smart investors look beyond fear. They understand the structures forming beneath the market stay. Patience, stay focused, and keep your analysis sharp.